Welcome to the DX Today podcast, where you get facts, not hype.
And today, we are embarking on, well, one of the most critical deep dives we've ever undertaken.
Yeah.
We're going to be analyzing these massive, almost invisible shifts happening deep inside the global financial system.
Yeah, specifically, we're looking at how the largest U.S. banks are implementing artificial intelligence. Our mission today is, I think, crystal clear. We are going to dissect the evidence of AI adoption, the actual documented proof from titans like JPMorgan Chase, Bank of America, Wells Fargo, Citigroup, and PNC.
Right.
But our focus isn't just on the cool new tech. We really need to analyze this central grinding tension between, the massive measurable productivity gains on one side.
And on the other, the very real, very explicitly communicated threat of workforce reduction.
Exactly.
And this is where the core paradox just jumps right out at you. It really sets the stage for, I think, the next decade of white-collar work. The scale of this transformation, it's just immense.
Okay, so give us a number. How big are we talking?
Well, the sources we're looking at, like McKinsey, are projecting that generative AI alone could inject somewhere between $200 and $340 billion in annual value.
$340 billion annually.
Annually. Into the global banking sector. So this is not small change. This is a complete restructuring of how profit margins are built.
That number, $340 billion, is just staggering. But it's that immediate trade-off that, you as a listener have to confront. That profitability is being directly, explicitly linked to efficiency gains.
Gains that require, as you said, constraining headcount growth, or in some cases we've documented, outright job elimination.
Yeah, we're seeing a system where this incredible increase in output is, it's fundamentally divorced from an increased need for human labor.
That's a perfect way to put it. And if we just zoom in on the initial snapshot of the impact, the output gains are already very, very visible. Across the board, these institutions are reporting a general range of, say, a 3 to 6% productivity increase.
Which is good, but it's not, world-changing. It's not a revolution.
Not yet. But the revolution happens when they target specific, high-volume functions.
Right.
Precisely. In these targeted functions, so you're thinking legal compliance, contract review, fraud analysis, we see reported output gains of 20% or even higher.
Okay, now that's transformative.
That is. This is where AI moves from being, say, an assistant to potentially becoming a replacement for certain kinds of routine labor. And the clearest signal of this, of structural job loss, it comes from the biggest U.S. bank, JPMorgan Chase.
What are they saying?
They've publicly stated that their operations staff, this is the engine room of the bank, could fall by at least 10% over the next 5 years. And that's specifically because of AI deployment.
And JPMC is the leader, sure, but Citigroup is being even more dramatic. They're planning something like 20,000 job cuts.
As part of a radical restructuring effort. And it's all fueled by this absolute necessity for efficiency.
It's such a palpable contrast, isn't it? You have one bank, JPMC, using AI to get stronger, to grow, and another, Citigroup, using it almost like a life raft, just to cut costs and survive.
It really is.
Okay, let's unpack all of this. We really need to look closely at what specific efficiencies these banks are realizing, where that massive value is being created, and, unfortunately, where the axe is falling first across the banking job market. So, kicking off this first section, we have to quantify this value. AI isn't some hypothetical tool anymore. The sources are showing it as a quantifiable efficiency engine that is like remaking the banking balance sheet right now.
Let's start with the macro context. The McKinsey Global Institute gives us a great framework for this. Their analysis estimates that successful broad AI adoption could add a consistent 2.8% to 4.7% of annual industry revenues.
Which doesn't sound like a huge percentage, but for these institutions.
For institutions posting hundreds of billions in revenue, you translate that percentage into dollars, and you're essentially generating tens of billions in new profit, just by optimizing the processes you already have.
And the interesting part is where that optimization is happening. The sources highlight that the potential gains in core corporate and investment banking activities, they range dramatically.
Yeah, they really do. You see this huge range from let's say, a moderate 30% all the way up to 90%.
90%? Why such a massive gap?
It depends entirely on the task's complexity and its repeatability. So a task like high-level strategy setting, that might see a 30% augmentation.
Yeah.
The AI finds the data faster, helps a human make a better decision.
Okay.
But a task like simple contract review or initial risk assessment, something that's rules-based, repetitive, That's where you could see that 90% figure.
And that 90%, that is transformative. That means nearly 9/10 of the human effort on that task is now automated, augmented, or, maybe just gone.
Entirely eliminated. That
Yeah.
90% is the figure that should really make you pay attention. It suggests that entire junior departments could, well, shrink to almost nothing if their core job is just rules-based document processing.
So if we look at the most immediate, highest volume opportunity, it's pretty clearly customer service, right? This is the low-hanging fruit.
Absolutely. The data is clean, the interactions are already logged, and the models can be trained and deployed at breakneck speed.
And the cost-saving potential here must be enormous.
It's huge. The research suggests that generative AI could reduce the number of human service contacts by up to 50% in banking.
50%, half.
Half. And when you think about the vast physical and operational cost of running a major bank's call center infrastructure across the globe, having that contact volume is a monumental efficiency gain. It flows directly into operating profit.
And we have a specific case study on this, don't we?
We do. A documented case study that validates this. A bank with 5,000 customer service agents. After they deployed AI, they saw a 14% increase in issue resolution per hour for the remaining human agents.
So the humans who are still there are more effective.
Much more. And crucially, they also saw a 9% reduction in overall handling time. The AI handles the simple stuff, it filters the information, and then it presents the human agent with a concise solution, which lets that agent handle the really complex issues much, much faster.
So it's measured improvement in human performance, all enabled by the technology.
Precisely.
And that efficiency gain, more output with the same number of people, it leads us directly into this concept that's really fueling these long-term job reduction forecasts. And that's agentic AI. I think we need to slow down on this and define it clearly.
Yes, this term, agentic AI, is absolutely critical because it moves beyond just assisting or augmenting a human worker.
How so?
Wells Fargo's head of consumer technology described it very succinctly and maybe a little chillingly as a 24/7, 365 digital workforce.
A digital workforce?
We are talking about autonomous software entities or agents that can monitor information, look for changes, spot anomalies, and execute complex multi-step tasks, all without continuous human input.
Okay, so let me see if I get the difference. A large language model, an LLM, is like a hyper-intelligent intern who drafts a report for you.
Right.
But agentic AI is like an employee who not only drafts the report, but also spots a factual error in the data, independently emails the source to get a correction, and then files the necessary audit trail, all without me asking.
That is precisely the difference. A great example in banking would be, say, an agent that's dedicated to auditing supplier invoices.
Okay.
If that agent spots a deviation of more than 5% from historical norms, it can automatically flag it, it can initiate a query to the vendor, track the response, and then file the full audit trail with a compliance officer. A human is only alerted if the agent gets conflicting data or hits a major regulatory flag.
And what are the projected savings from implementing this digital workforce?
McKinsey projects that this specific technology could lower overall operational costs by 20% or more in banking.
20%.
And let's translate that. That 20% cost reduction often equates to something like 9% to 15% of the bank's total operating profits, potentially just saved.
So when you hear bank executives talking about 10% or 20% staff reductions in operations, this is what they're talking about. This is the technology they're banking on to justify that move to shareholders.
This is it, the digital employee.
But the sources also provide some necessary caveats, which is important for you to hear. These gains are not guaranteed. And the banking industry is, well, it's famous for high-cost tech projects that don't deliver.
We have to highlight the McKinsey cautions here. They note that historically, these kinds of productivity gains, they might eventually just get competed away.
What do you mean by that?
Think about ATMs. They dramatically reduced the need for human tellers, right?
Mm-hmm.
But the banks didn't just pocket all that profit. They reinvested it. They opened new, smaller branches, offered more complex services.
And ultimately, the consumer benefited, but the initial competitive advantage for the first bank to do it, it just disappeared.
It was neutralized. It's a crucial economic principle. Competitive pressure forces you to pass efficiency gains on to the consumer. So to avoid that trap, banks need to avoid 4 common pitfalls that the research identified. And I think we should detail these because this is crucial for anyone thinking about how any knowledge-intensive company might adopt AI successfully.
Okay, what's the first mistake companies are making?
The first pitfall is just copying generic use cases instead of basing them on your actual strategic priorities. A bank might deploy a generic LLM chatbot just because everyone else is.
Keeping up with the Joneses.
Exactly. When their actual strategic business priority is reducing the multi-billion-dollar cost of regulatory fines through better fraud detection, that needs a tailored, strategic solution, not a generic one.
That's a great distinction. Deploying tech just because it's available, not because it solves your biggest pain point. What about the second pitfall?
The second is deploying broad but shallow tools. So this delivers these diffuse, minor productivity gains across the whole organization.
Like the AI assistant that makes every employee 3% faster at writing emails.
Right. It's nice, but it's not transformative. The focus should be on deep, transformative improvements in a few key areas, like automating 90% of the loan underwriting process.
So one AI that automates 90% of contract review for the legal department is exponentially more valuable than a tool that makes 5,000 employees marginally faster at internal chats.
Precisely. The third pitfall, which directly impacts this job conversation, is the failure to invest enough in work redesign and employee training.
What do you mean by work redesign?
Well, if you successfully automate 50% of a job, you can't just leave the human employee with the remaining 50% of random tasks and expect them to stay productive. You have to redesign the job entirely.
So you move the human toward higher value, judgment-based work.
And you train them in AI oversight. If you don't do this expensive, difficult work redesign, the efficiency gains just stall out.
That's a major point. It's not just about eliminating tasks. It's about creating new, more complex human roles. And the final pitfall.
The fourth is allowing the proliferation of uncoordinated micro-initiatives. This happens when every department rushes to deploy its own favorite AI tool. One team uses vendor A, another uses vendor B, all using different data standards.
It sounds like a nightmare.
It's a total mess. This lack of enterprise coordination leads to security risks, model sprawl, conflicting data standards, and it eventually undermines all the initial gains you might have made. Strategic focus, enterprise architecture, and strong governance are, well, they're non-negotiable.
Okay, so now that we have the macro context and the common traps to avoid, let's get into the specifics of the giants leading this charge. We have to start with JPMorgan Chase. They're not just implementing AI, their goal is to become what their chief analytics officer calls a fully AI-connected enterprise.
Yeah, the ambition in JPMC is comprehensive. The language is very clear. Every employee they envision will have a personalized AI assistant. Every routine process will be powered by AI agents.
Every client interaction, too.
Every client interaction outside of a branch will be supported by an AI concierge. They are literally building an operating system for finance that covers everything except, the actual handshake and the really complex judgment calls.
And this commitment, it's backed by their balance sheet. Their investment is just staggering, which is what makes their case so compelling to watch.
It is. JPMC's technology budget has been steadily climbing. It's projected to hit $18 billion in 2025. Which is up from $17 billion in 2024.
And how much of that is for AI?
What's crucial for our deep dive is that about $1.3 billion of that massive budget is dedicated specifically to advancing their AI and machine learning capabilities. This isn't just a rounding error. This is major capital expenditure on replacement technology.
And to manage all this, they're not just buying software, they're building a specialized army of experts.
They are. JPMC has already assembled over 2,000 AI and machine learning experts and data scientists, and their target is to grow that specialized workforce to 5,000. And importantly, they also operate a 200-person elite AI research lab. This thing functions much like the labs at Google or Meta, which means they're generating their own core intellectual property, not just buying off-the-shelf solutions. They want to own the algorithms.
Okay, so let's talk about the scale of adoption. They didn't just wait around for vendors. They developed their own LLM suite, their own platform.
Yes, and that is a major, major differentiator. This internal LLM suite is already being used by 250,000 employees.
250,000 people.
It's essentially their entire workforce outside of the branch network and the call center staff. This is not a pilot program. This is the core operational reality for 250,000 people.
That scale is just mind-blowing.
It is. And the usage is consistent. About half of those 250,000 employees use the platform every single day. The system is also dynamic. It incorporates models from both OpenAI and Anthropic,
which lets them constantly improve it.
It lets them update the system every 8 weeks with new data from their own secured internal repositories. And this ensures their AI is trained on their own proprietary information, which gives them a competitive edge and maintains data security.
Okay, let's look at some specific high-impact tools they've deployed. First, there's the contract intelligence platform, COIN.
Right. Koyan automates document analysis across their legal and compliance departments. The result? It has saved the bank over 360,000 work hours annually.
Let's just pause on that. 360,000 work hours. What does that mean in terms of jobs?
Well, if a full-time employee works about 2,000 hours a year, that is the equivalent of 180 full-time jobs that are now being handled by Koyan.
Right.
And those are jobs that are now maybe focused on higher value activities, or more likely, jobs that are just being eliminated through attrition or restructuring.
And for the front office, where those human relationships are so key, they have something called Coach AI. This is where we see that do more with the same people philosophy in action.
Yes, exactly. Coach AI is designed to make human advisors radically more efficient, not to replace them. It helps them access information, client histories, regulatory updates about 95% faster.
And the firm projects?
Right.
That this will empower their existing advisors to expand their client rosters by as much as 50%.
Over the next 3 to 5 years, yes. So your advisor can now serve 150 clients instead of 100. That means JPMC can generate 50% more revenue without having to hire a single new relationship manager.
This is where it gets really interesting, and it's where we find the metric that directly links AI implementation to measurable workforce displacement, the Know Your Customer, or KYC process.
We should probably define KYC first.
Good idea.
KYC, it stands for Know Your Customer. It's the mandatory due diligence process banks use to verify the identity and legitimacy of their clients. It's for complying with anti-money laundering and counterterrorism financing regulations. It is a massive, rules-based operational burden.
And the data on GPMC's KYC process, it's the smoking gun for staff reduction.
It absolutely is. Let's just look at the numbers the bank provided. In 2022, JPMC processed 155,000 KYC files, and they used a workforce of 3,000 employees dedicated to that task.
Okay, 3,000 people.
By 2025, that output is projected to skyrocket to 230,000 files. That's a nearly 50% increase in volume.
Right.
But, and this is the crucial part, that increased volume will require 20% fewer employees.
Wait, let's just be really explicit about that trade-off. They are increasing their output by half, 50% more KYC files, while at the same time they're reducing the required staff by a fifth.
Exactly. And that 20% reduction means approximately 600 specific KYC roles are being automated away.
So what were those 600 people doing?
They were spending their time primarily on rules-based checking, cross-referencing databases, documenting sources, filling out standardized forms. Agentic AI is designed to do that exact task. The staff that are left are now the checkers, as we discussed earlier.
Right. They're overseeing the AI's output and handling the complex, weird cases that require human judgment or regulatory interpretation.
Right.
And that quantitative success leads directly to the ultimate bottom line figure, doesn't it?
It does. The bank's president and COO, Daniel Pinto, projects that AI use cases will deliver between $1.5 billion and $2.0 billion in tangible annual business value for the bank.
That's a hard dollar figure.
A very hard number.
Yeah.
And it justifies every strategic investment, every technology budget increase, and crucially, every single headcount decision moving forward. When you frame job cuts as a necessity for delivering $2 billion in annual profit, the motivation becomes inescapable.
That story at JPMC sets up a really interesting comparison with our second titan, Bank of America. They took a slightly different route, right? They focused first on what the customer sees.
That's right. Bank of America was an early and very successful mover with Erica, their AI-driven virtual financial assistant. They launched that way back in 2018.
And it's been a huge success.
Undeniable. It boasts over 20 million active users and has logged more than 3 billion with a B cumulative interactions since launch. That's a massive adoption milestone. It shows clients are perfectly willing to engage with AI for routine banking.
And Erica isn't just answering questions. It's a measurable revenue engine. The sources noted that it contributed a reported 19% revenue boost just by strategically suggesting new products during customer chats.
It's a huge boost from an AI cross-selling. So building on that consumer trust, BOFA then shifted internally with Erica for Employees, which they launched in 2020.
And this internal version was also adopted quickly.
Very quickly. It's achieved a significant milestone. Over 90% of the bank's roughly 213,000 employees use it. That is extremely high internal adoption across all divisions.
And what did that high adoption rate deliver in terms of operational excellence?
Significant gains. Erica for Employees has reduced calls into the IT service desk by more than 50%. The chief technology officer stated that AI is having a transformative effect on employee efficiency, not just in IT, but everywhere.
What about about for developers?
They reported that generative AI-based coding assistants are yielding 20% efficiency gains for developers, and AI is saving tens of thousands of hours per year just by preparing standard materials for complex client meetings.
So BOFA is achieving tremendous efficiency, but how does their workforce management compare to JPMC, which is planning those specific operations staff reductions?
Their approach has been characterized as carefully orchestrated, small-scale adjustments. So they trimmed positions from 218,000 down to 213,000, but primarily through natural attrition and selective hiring freezes.
So not massive structured layoffs.
Right. The CEO, Brian Moynihan, has said publicly that they manage their workforce carefully, avoiding deep cutbacks unless absolutely necessary. They're managing the reduction through constrained growth, letting people leave, and then replacing them with AI. It reflects a slightly more cautious, maybe more culture-focused approach than what we're seeing at, say, Citigroup.
Moving into our third section, we really see the full spectrum of AI strategy. On one end, you have Wells Fargo, which is positioning itself as an agentic AI pioneer.
And on the other, you have Citigroup, which is deploying automation as part of a really radical financial restructuring.
Let's start with Wells Fargo. They're leading with their AI-powered customer assistant, which is called Fargo.
And it operates on a massive scale. Fargo handled 245.4 million interactions in 2024 alone. That's more than doubling the volume from the prior year. That kind of growth just shows massive customer comfort with the tool.
But the critical detail we saw in the sources about Wells Fargo is their safety protocol, right? Especially given their history with regulatory issues.
That safety point is huge. Wells Fargo has achieved this scale while adhering to a really strict internal protocol. They never expose sensitive customer data to a public or even a commercial large language model without anonymization and filtration.
That adherence to data privacy and sovereignty is, it's essential in the regulated banking world. It sets a high bar.
It really does. They also seem to be avoiding vendor lock-in with what they call a poly-model approach.
What does that mean, polymodel?
It means they're pragmatic. Fargo primarily uses Google's Gemini Flash 2.0, but it also leverages smaller open-source models like Llama internally. And sometimes it uses OpenAI models if they're needed. This strategy ensures they're not tied to a single vendor or a single technology, which gives them resilience.
I thought there was a fascinating detail about language adoption, too.
Oh yeah, an amazing accessibility win. Since its rollout, Spanish language adoption of Fargo has just surged. It accounts for more than 80% of its usage, which suggests that AI is actually improving inclusion.
And just like JPMC, Wells Fargo is now rolling this out enterprise-wide to all 215,000 employees.
Yes, they're using Google Cloud's agent-based platform to roll out both generative and agentic AI. The plan is for custom AI agents to serve everyone from branch bankers and call center staff all the way to investment bankers.
And the CEO, Charlie Scharf, has been very clear about the implications for headcount.
Very clear. He stated that AI poses a significant opportunity to improve efficiencies and that it will influence companies' headcount decisions. The message couldn't be clearer. The technology is coming, and it's going to reshape the workforce.
And to prepare their workforce for this, they're investing heavily in specific training.
They recognize that skills gap. Wells Fargo has put 4,000 employees through Stanford's human-centered AI program. This isn't just, some internal software training. This is a heavy investment in an academic-level understanding of how to manage an AI-powered enterprise.
They're creating an elite group of managers who are equipped to oversee this new digital workforce.
Exactly.
Now, let's look at Citigroup. Their strategy is just a stark contrast to Bank of America's carefully orchestrated attrition. Citigroup represents the most aggressive job displacement among all the major banks.
Yeah, Citigroup is undergoing radical surgery. In January 2024, they announced plans to cut 20,000 jobs. That's roughly 10% of their workforce over 2 years.
And that doesn't even include the spin-off of their Mexican unit.
Right, there's an additional 40,000 from the planned spin-off of Banamex. This move isn't about constrained hiring. It's about deep structural reorganization, and automation plays a critical role in justifying those cuts.
And the context here just tells the whole story. Why is Citi being so aggressive?
It's an existential imperative for them. Citigroup is financially the weakest among the 6 largest U.S. banks when you look at profitability metrics. Now, they're still profitable, but the pressure to reduce these bureaucratic management layers and boost their return on equity is just immense.
So for them, efficiency via AI and automation isn't just strategic.
It's a matter of survival to satisfy shareholders. And they're moving fast. By April 2024, they had already executed 7,000 of those planned cuts. This is a high-speed execution plan.
So that shows the full spectrum of responses. You have JPMC automating to grow profits and constrain growth. Beauvais is automating to manage growth through attrition. And then Citigroup is automating just to survive a necessary massive restructuring.
Which brings us to PNC Financial. They demonstrate what we could call a middle path, maybe a more conservative path. Their head of enterprise data, Ned Carroll, called it prudent innovation.
Prudent innovation. What does that actually mean in practice, especially in a banking environment where everyone else is chasing after $2 billion gains?
It means a highly measured approach. It's focused heavily on demonstrable value, rigorous risk management, and above all, maintaining customer trust. PNC uses AI effectively for high-value tasks, things like advanced chatbots, predictive risk analytics, stress testing, and improving credit scoring accuracy.
But the crucial philosophical difference seems to be that they prioritize the problem over the tool.
Exactly. Carroll emphasizes that their core philosophy is to ask, what problem are we actually trying to solve here? And sometimes the data shows that the most cost-effective and low-risk solution might just be traditional process improvement, just streamlining human steps, not deploying a complex, expensive AI model that requires huge regulatory oversight.
So they accept that they might lose that first mover advantage, but in return, they gain greater stability and a lower risk of some costly deployment failure.
That's the trade-off. They prioritize optimizing their return on investment and minimizing regulatory risk. It ensures AI is only deployed strategically, where it clearly and reliably outperforms traditional proven methods. PNC is sort of the necessary reality check for the whole industry, reminding us all that AI hype often outpaces reliable execution.
Okay, moving into Section 4, we have to address the single most pressing concern for, I think, anyone listening in the knowledge economy: the workforce implications and the nuance of job displacement. We keep hearing this consistent messaging from executives, what we're calling the do more paradox.
It is a very meticulously crafted message. It's designed to signal efficiency to investors without triggering a panic among employees. The executives frame AI as allowing organizations to do more with the same people or potentially fewer.
So it satisfies both audiences.
Exactly. It satisfies shareholder demand for efficiency while subtly preparing the internal workforce for shifting roles, or, critically, for constrained hiring in the future.
JPMC's leadership has been the most direct in tying this messaging to explicit staff cuts.
Yes. The consumer banking CEO, Marianne Lake, she announced a plan to reduce operations staff by 10%. And she called that a conservative estimate.
And this was in specific areas.
In core rules-based areas like fraud processing, statements, and account services. This wasn't some vague aspiration. It was a targeted public commitment to staff reduction in specific parts of the back office.
And that operational reduction is backed up by a clear shift in their hiring mindset, as articulated by the CFO.
Yeah, JPMC CFO Jeremy Barnum made this very clear to investors. He stated they would spend less on hiring in 2025, less than $95 billion, which is a significant drop from $100 million in 2024 and $200 million the year before that.
And he was pretty explicit about the reason.
Well, yeah. He said they have a strong bias against the reflexive response to any given need to hire more people. The new expectation is that AI will handle the increased workload or demand, not new human hires. And this hiring constraint, it acts as a powerful silent form of displacement.
And Goldman Sachs is signaling the same thing. Their CEO, David Solomon, talked about the need to constrain headcount growth and conduct limited layoffs to really benefit from AI. He's tying efficiency directly to reduce hiring spend.
Which leads us to the consensus on where jobs are most exposed. And this is crucial for you to understand. The sources all confirm that back and middle office operational roles, they face the greatest exposure.
So we're talking about jobs focused on fraud processing, routine compliance reporting, payment processing, data entry.
High-volume document review. All these rules-based, predictable, scalable tasks that agentic AI is just designed to conquer.
One of the JPMC execs, Derek Waldron, he characterized this perfectly as a shift from makers to checkers.
It's a great metaphor. The makers are the employees who create the reports or process transactions or draft standardized communications. The checkers are the highly compensated managers who now just oversee the AI agents performing that work.
So the job fundamentally shifts from execution to oversight,
which requires far fewer people. For example, a department of 50 financial analysts churning out monthly compliance reports that might shrink to 5 highly skilled AI supervisors who are just reviewing the output. the vast majority of the making jobs are now gone.
Conversely, the relationship-based roles are more insulated.
Absolutely. Front office positions that require complex client relationships, nuanced advisory services, subjective, judgment-intensive decision-making, those are emphasized as growth areas. A machine can analyze a client's portfolio data perfectly.
But it can't build trust.
Not yet.
Yeah.
It can't build the trust required for a multi-million-dollar complex financial transaction or advice on a generational wealth transfer.
But even in those seemingly safe divisions like investment banking, the implications for career pathways are really significant. This feels like an existential risk to the apprentice model, the way every finance professional learns the business.
This is perhaps the most serious implication for the long-term health of the entire industry. JPMC leadership discussed potentially changing the traditional ratio of junior bankers to senior managers from, say, 6-to-1 down to 4-to-1.
And why is that so critical?
Because the junior banker role-making pitch books, cleaning data, conducting precedent analysis, that is the traditional apprenticeship. That low-level, high-volume, tedious work is what teaches you institutional memory and contextual understanding. If you eliminate 2 out of every 6 of those entry-level spots, you choke the pipeline of future leaders.
You're automating away the foundation. How does the structure stay stable if the foundation is gone?
Exactly. And the sources then add an even greater pressure point on those few remaining junior roles. It was noted that half of the remaining junior positions could potentially shift to lower-cost cities like Bengaluru or Buenos Aires.
Why would they do that?
To provide 247 global coverage and to reduce costs even further.
So not only are there fewer opportunities in traditional financial centers like New York or London, but the roles that are left are often geographically relocated. That fundamentally changes the entry-level career experience for someone who wants to eventually reach senior leadership in the West.
Yeah, the destruction of that traditional ladder. It means the pathway to the top becomes steeper and much, much narrower. And it forces banks to completely rethink how they transmit institutional knowledge and strategic context to the next generation of leaders. It's a huge gamble for them.
Okay, so despite all this executive signaling of massive savings and impending job cuts, the sources do offer a critical reality check that might temper the anxiety a little bit.
Yes, this is where the MIT research comes in, and it provides a really important nuance. It suggests that despite these collective investments exceeding $30 billion by major corporations in AI, most companies, this is not just banks, have not yet generated tangible, significant returns on those projects.
So the timeline might be longer than they think.
The timeline for true sustained cost reduction and the full realization of those $1.5 billion projections. It may be significantly longer than bank executives initially expect.
But why? What's the friction point that's preventing them from hitting those numbers right now? Is it just integration failure?
It's multi-layered. One major issue is data quality and data debt. AI models are only as good as the internal data they're trained on, and cleaning up decades of messy, inconsistent financial data is a mammoth undertaking.
And then there's regulation.
Second is regulatory friction. The moment you automate a compliance task, regulators demand proof that the AI is non-biased, traceable, and secure. That adds months or even years of validation. And third, genuine integration. Connecting these new agentic AI platforms to legacy mainframe systems is incredibly complex and slow.
So while the displacement is absolutely being planned and communicated, the actual pace of mass job loss might be more gradual, and that gives workers a critical window of breathing room to adapt their skills.
Precisely. The announcements are real and the intention is real. But the complex operational execution of mass automation at scale, with demonstrable cost savings, is proving to be a much slower and more difficult process than the executive hype might suggest.
That slight delay, that reality check, it gives us a chance to focus intensely on Section 5, the adaptability imperative. Because whether the displacement is gradual or sudden, the need for new skills is accelerating at an alarming rate.
The speed of skill change is perhaps the scariest finding in the PwC research that was cited. Their analysis shows that skill change is occurring 25% to 35% faster in AI-exposed jobs compared to the less exposed positions.
What does that mean in real terms?
It means the required skill set for a bank operations analyst today will be profoundly different just 2 years from now, and that puts immense pressure on continuous learning.
But for those who do adapt, the reward is substantial. The market is already pricing in AI proficiency.
Oh yes, the sources point to a substantial wage premium, estimated at roughly 25% to 30%, for workers who have demonstrable AI skills compared to those in similar roles without those capabilities.
So what are those skills?
The ability to prompt an LLM effectively, to oversee an agentic AI, or to integrate AI insights into strategy that is commanding an immediate, tangible financial reward.
That 25% premium really shows the value the market places on people who can immediately integrate and use these tools. And the industry response, thankfully, has been to invest heavily in training. Let's look at those bank-specific examples again.
Sure. Wells Fargo, as we mentioned, put 4,000 employees through that Stanford human-centered AI program. Bank of America's Academy is using AI conversation simulators, which is a key training tool.
Right, I remember that.
Their staff completed over 1 million simulated client interactions in 2024. It's specifically teaching them how to maintain human interaction skills in an increasingly automated environment.
And JPMC.
JPMC has initiatives aimed at educating every single employee on how AI can be applied to their specific role. They're trying to make AI literacy a core corporate competency.
However, the World Economic Forum research brings up a structural tension here that's worth exploring. It relates back to this idea of corporate self-interest versus employee development.
Yeah, it raises a fundamental economic question about the employer's motivation. While companies publicly commit to upskilling their workers, the sources note that the follow-through may be limited.
Why is that?
Because employers recognize that workers often leave after gaining new, generalized, portable skills. And this materially reduces the incentive for the bank to make heavy investments in training that just makes their worker more employable somewhere else.
So the bank would prefer to pay a premium for existing AI talent, or maybe only invest in highly job-specific AI training that isn't easily transferable.
That is the core friction. They want workers to gain skills that benefit JPMC, not skills that are going to launch a career at Goldman Sachs or Google.
So for the worker, the message has to be to focus on developing the non-automatable skills, the things that allow them to thrive regardless of what their company invests in.
Right. And what are those durable skills that the sources suggest?
Well, the durable path forward seems to focus on the skills that AI is currently worst at replicating. Things like complex subjective judgment,
Deep relationship building,
creative, nonlinear problem solving.
and cross-functional integration, that ability to connect disparate parts of the business. These are the skills that survive that transition from a maker to a checker.
So at the end of the day, what does this all mean? This deep dive has shown, I think, beyond a doubt, that the banking sector is serving as a crucial, well-documented leading indicator for all knowledge-intensive industries.
The evidence is synthesized and structured. We have measurable hard dollar gains like JPMC projecting that $1.5 to $2 billion in annual value.
And that's directly fueling structured displacement, like Citigroup's 20,000 job cuts and JPMC's 10% operational reduction.
The trade-off is real, and it is accelerating this shift away from rules-based operational work and toward judgment-based, complex advisory roles.
I think it's time to heed that stark warning from Jamie Dimon that we saw in the sources. People should stop putting their heads in the sand about AI's impact on jobs.
I agree the transformation is measurable. It's driven by massive capital investment, clear executive signaling, and these successful high-volume implementations like Erica and Fargo.
The banking sector has the capital, the data, and the regulatory pressure to move faster and deploy AI at a larger scale than almost any other sector out there.
Their experience over the next 5 years, the success or failure of realizing that $340 billion in projected value, that will tell us exactly what the future of work looks like for white-collar professionals everywhere.
Which brings us to the challenge for the industry and the final provocative thought we want to leave you with. It's balancing that shareholder demand for immediate, radical efficiency with the broader social costs of workforce displacement.
Right. If, as McKinsey cautions, those efficiency gains are eventually competed away, if those initial $2 billion profits dwindle because of competition or regulatory costs, as history suggests they might.
Then will the industry find a way to maintain the aggressive headcount cuts they've already implemented, but without realizing the full intended profit margin? What is the breaking point for the social contract between banks and their employees if mass job elimination happens before there's measurable, sustained profit? Something for you to mull or explore on your own.